Hey, this is Chris from Stockspot. In this video, I'm going to be sharing a quick update on how our portfolios have performed over the last 12 months to the end of March 2025. I'm summarizing our core portfolios, the sustainable portfolios we have, and then the inflation and income portfolios we offer. So first of all, starting with the core portfolios. Now these have had a pretty good return over the last 12 months, all things considered, especially given the pretty steep sell-off we've seen in share markets over the last 3 months. Although returns have come down a little bit versus January, they're still positive and a lot further ahead than most diversified portfolios are at this point. So they've had returns of between 11.9% over 12 months for our conservative Amethyst portfolio to 12.3% for our high growth Topaz portfolio. You often see that these numbers are a bit further apart. The reason they're quite close together at the moment is that government bonds and Australian shares have both had similar performances over the last 12 months of around 3%. And so whether you're in a high growth or a conservative portfolio hasn't really mattered. Your overall return has been quite similar because it's really the allocation to these two assets that's most different between the portfolios. Now, the biggest contributor to that performance over the last 12 months has certainly been gold, which is up 46% over the last 12 months. It just keeps on running and it's now at 5,200 Australian dollars an ounce. You know, I've recently put out some content talking about why I'd be cautious chasing it as an investor at the moment. And actually what we're seeing at the moment is some of our clients getting rebalanced out of gold because their allocation has become too big. Because our standard allocation of 14.8% has grown in some of these client portfolios to 20% because of this great performance. And so we're rebalancing back to about 14.8% and allocating that money to other asset classes that haven't performed as well, including Australian shares after that big trade tariff related sell-off we've seen over the last couple of months. So that's our core portfolios. The sustainable portfolios have performed a little lower over the last 12 months at 8.9% for our high growth to 9.9% for our conservative. It's interesting that the returns are flipped from what you'd expect here, and the conservative portfolio has performed better than the growth portfolio. It's quite unusual, but it happens occasionally when government bonds do better than shares. And in the sustainable shares ETF that we use, it hasn't done as well as the indexed ETF because it doesn't have that allocation to commodities that have done quite well, and it's highly weighted towards technology companies that have really been pulled back in this US sell-off that we've had of late. So still a good return, and a lot of that 8.9 to 9.9% has come from gold because of gold's 46% return over the last year. And if you look at typical super fund returns or diversified funds over the last 12 months, you'll generally see that they're lower returns because most don't have that allocation to gold. So we're happy to see this sustainable performance. The global sustainable and responsible ETFs have both had positive returns as well, but only slightly positive, and have all been helped by the lack of hedging. We don't hedge any of our global exposures, and so they've all benefited from the falling Australian dollar, and it's had a pretty heavy sell-off this year due to our exposure to China and these retaliatory tariffs that are happening between the US and China at the moment. So that's our sustainable portfolios. Finally, on the income and inflation portfolios, now these have also done quite well over the last year with returns of 11.5% for the income portfolio and 25.1% for the inflation portfolio. Certainly the standout of all of our portfolios of the last year has been the inflation focused portfolio. As concerns around inflation have heated up in the economy, and particularly around stagflation, the potential for low growth and high inflation for an extended period, assets like commodities, gold miners, and silver and infrastructure have all really benefited, and these are the assets that there's a higher weighting to in the inflation portfolio, and is really what's driven the 25% return over the last year, which is really quite a bit higher than our other portfolios. We've also seen pretty significant inflows into this portfolio over the last couple of months, as you'd probably expect given the performance. We actually had 10% growth in the overall assets in this portfolio last month, but I would caution people against switching to the portfolio that's done the best over the last 12 months. This isn't a great long-term strategy, and it's likely that other portfolios will do well as well over the long run. And so I would be sticking to the strategy you have. If you're in that inflation portfolio, great, but don't chase it just because it's up 25% over the last year. But if you are interested in it, it may be something you add an allocation to in 6 or 12 months time, particularly if it has a period of not as strong performance. And so that's the summary of how the Stockspot portfolios have done over the last 12 months. I mean, the highlights have been the gold performance, really helping all of the portfolios withstand this period of market volatility and concerns around trade tariffs and the impact of the new US policy. And this has really helped to provide a cushion for all of our portfolios. That said, we're rebalancing out of a little bit of gold and redeploying that into other asset classes that haven't done as well.